Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that could be a bit confusing, misleading, and take you off course now to make it actionable, understandable, and clear. What a week. What a show. Whew, what a week indeed. I want to look at three items today. The first being a little bit of volatility. You may have felt it. As I'm recording this, the stock market is down in a major way. March 6th. It's down in a major way. I want to talk about the United States performance and international performance. Go back to that song that I always sing about diversification. I then want to look at, this was a profound article sent to me by a friend of the show. It was so good, it bounced other items that we were going to discuss by a gentleman named Alan Roth, who, yes, he's an hourly financial advisor. What? There's so few of us. That's always a gift to see someone else out there. He has a great article. It's the 7 Deadly Investing Sins Clients Make, and I just couldn't agree more with what he said. And then if we have time, and we may not, so measure your expectations, we might talk about how to buy a car in 2025. Because tariffs are coming, team. Tariffs are a-coming. Whew. But at the top, this is something I found on X. This is the performance of various stocks in 2025, all right? U.S. stocks. Apple, this is in 2025. It's down 3.1%. Microsoft, down 6.3%. NVIDIA, down 12.4%. Amazon, down 4.7%. Alphabet, known as Google, down 10.3%. Our one winner, Meta, Facebook, up 14.2%. Tesla, down 26.7%. What a profound change we've experienced in 2025 than 2024. And let's zoom out just a touch more. The United States stock market, as this is being recorded, I'm using the ticker symbol VTI, which is the Vanguard Total Stock Market Index for the United States. It is down 2.68% compared to the International Index, which is up 7.78%, VXUS. I'm going to read that again. Go ahead and bring the children in for this one. VTI, today, this is the American stock market, year to date, 2025. It is down 2.61%. International is up 7.78%. So for the international investor, you know what they think about 2025? It's outstanding. It's been incredible. What a great start to the year. We're only in March, and I'm already up 7.78%. Oh, hasn't this been the longest road? And this, by the way, this could be a pump fake. We don't know. But for all those sermons I've preached over all the years, this broken clock may be right once, twice a day at least. It is pain to be diversified. So one of the hardest things I've been encountered with, both for myself and for clients, is seeking to convince people to invest in international stocks, because it has been such a long road for the international stock investor. When we zoom out and we say, well, what about the last 5 years? Well, the last 5 years, VTI, U.S. stocks are up 87%, whereas the last 5 years, international are only up 27%. So you could at least empathize with an investor or an advisor who, while they're trying to convince the client to have international exposure, boy, is it tough to do in the face of year after year after year of underperformance by international stocks. We'll see if it lasts, but the application of this sermon is, in my view, buying ticker symbol VT or exposing yourself in some way to international stocks is going to help you not flip-flop. The great risk here, and this is what I want you to guard against, do not chase performance. You're bound to do worse. And we'll talk about that with Mr. Roth's article. But suffice to say, the start to this year for the globally diversified, it hasn't been that scary. For the globally diversified, you're up a little bit. So VT, you're up about 1.2%. That's that total world market. Because international stocks have pushed ahead the indice. Stay diversified. This article, excellent article sent in by a friend of the show. Oh, we could talk about, I put a link to it in the show notes. This is Mr. Alan Roth, who I really didn't know a lot about, but I'd been researching him prior to using this article for the show. He's great. He's so great. He starts the article telling this story about what he did in 1980, about how he basically, he says he would have had $1 million had he invested in an index fund instead of gold. So in 1980, precious metals were in vogue, and everyone was telling you, it's all about metals. What he's warning us against is be very careful about following the crowd and the new shiny object. He says in this article, gold was the ultimate shining object. But guess what? He says he wasn't the only one who knew the money supply was increasing, nor was he the only one who read articles about the collapse of fiat currency and suspended common sense, as if we would be showing up at the supermarket to buy groceries with gold. So he's talking about himself. Alan Roth himself elected to buy gold because that's what people were doing, not realizing everyone else knew the same secret, so there wasn't a deal to be had. Had he just invested in an S&P 500 index fund at that same time, he would have had $1 million today. But here he goes. I'm going to read. I won't have the time to extrapolate on each point, but I'm going to read these 7 deadly sins that he sees clients make. And I always appreciate a practitioner's advice more than just a journalist advice, although I really like the great journalist. But boy, I can relate to so many of these. Sin number 1, and I'll go back. Buying high, selling low. Number 2, forgetting arithmetic. Number 3, chasing shiny objects. We could talk about Cathie Wood's arc there. Number 4, confusing knowledge with unique knowledge. That's my favorite one. We're definitely going to spend time on that. Number 5, suspending common sense. Number 6, creating unnecessary complexity. Maybe my second favorite. And there we go. To lead the close this up, confusing speculation with investing. Number 7. Back at the top, buying high, selling low. What happens here? This is not just retail investors and people off the street. This is institutions as well. When the market's cooking and going up a lot, people will push to be in stocks. And when the market's down, guess what? They will pull away. The data is there. What Mr. Roth is saying is, oh, by the way, even your advisor does the same thing. He says there's evidence advisors are even worse at market timing. That's me. Because when markets surge, we want our clients to do well. And they may be telling us how well their neighbor is doing. The article continues, we can increase equity exposure. When markets plunge, we're afraid they will fire us or even sue us. So we reduce equity exposure, telling our clients something like, this has never happened before. Boy, that's the truth. That's the truth. Forgetting arithmetic. This is, I talk about this quite a bit, but active management doesn't work. So he explains there's a virtual certainty that the average investor will earn the market return less the fees they pay. So alpha, that's that risk-adjusted return. That's the idea of I'm going to be a great stock picker. After fees, it's negative. So if you believe in arithmetic, go index funds. Chasing shiny objects. This is one of my favorite ones. And of course, I see this all the time, but I feel it in my own heart. I'm no different than anyone listening. I have the same proclivities, and we've met the enemy in investing. It's us in the mirror. I have great lucidity and clarity of thought with clients' money. I find it much more difficult with my own. There's a lesson in that. All right. Mr. Roth brings up Cathie Wood's ARK Innovation ETF. You remember this? This used to be the rage. I'm talking on the Wall Street Journal all the time. And I like Cathie Wood's writing. I like her company's writing. It's really interesting, kind of future tech type stuff. But listen to this. Since inception, it's slightly bested the index, this ARK ETF. It's a bunch of high-tech firms. The fund returned nearly 10% annually. But check this out. The average investor in that fund, the annual return was a negative 25%. How'd they do that? Even though the ETF earned a spectacular 153% return in 2020, according to the article, the money poured in at the wrong time. So the timing of your investment in these funds, when you look at the timing, people did not do as well. And they chased the shiny object. And I recall multiple times where it was very difficult to convince folks that, it's unlikely. It's very unlikely that her performance is going to keep going. She's really pushing it risk-wise. Eventually it came back. This is my favorite one, confusing knowledge with unique knowledge. Confusing knowledge with unique knowledge. So he says this, I hear statements like the following, I don't want international stocks with 2 wars going on, so much turmoil. You ever heard that before? AI is going to change the world. I want more NVIDIA. The Fed is lowering rates, so I know stocks and bonds will increase in value. All those comments, Mr. Roth gets it. He calls this the markets are stupid hypothesis. And I couldn't agree more. A low view of the markets and their efficiency can cause people to take huge bets one way or the other, and ultimately they are following the herd. They are simply chasing performance. So I don't know how performance will end up in 2025. You heard me read Apple and Microsoft, NVIDIA, their start to this year. When you read an article in the newspaper and it propounds how wonderful AI will be and how many billions of dollars these companies will spend on it, and you think to yourself, aha, I will invest in NVIDIA. Did you know that that information is not unique to you? That's not unique knowledge. So you have to disabuse yourself of that belief that somehow if you read or understand something, even if it's water cooler talk, you need to be so suspicious of this secret information that you might have that others don't. It is the exception. And why do I believe it's the exception? Because a bunch of hedge fund guys will go to jail for insider trading. And if all they do is try to get an edge and they can't do it legally, it's going to be real tough for you or I. Real tough. Okay, so spending common sense. You betcha. Here's his examples. Being offered a product that gives you the upside of the market with no downside risk. You ever heard that before? Here's a financial product. I'll give you the upside of the market, no downside risk. They don't think about, and this is some form of annuity he's referencing, the commission you pay, the overhead, and the company's still making a profit. How are you getting better than that deal? Subscribing to a monthly newsletter for $200 if you want winning stocks and strategies. Nope. Remember that information advantage thing? Not real. And then he says, here's a summary of the product along with the required disclosure amount, a document. So any sort of disclosure document, he's reminding you, is not for your benefit. It's for the companies. Complexity, boy, isn't that the case? Anytime you are introduced with complexity, it's not to your advantage. It's not to your advantage. One of the great difficulties clients have who've perhaps been with an advisor or a bank or wealth manager who's put them in very complex strategies is learning that it wasn't helpful. And this will relate to, if we have time for this car talk, I know y'all want car talk at the end, it'll relate to it potentially. Complexity is oftentimes job security for the advisor. So if I can convince you that what I do is so difficult and relies upon such proprietary knowledge and difficulty that you could never even come close to understanding, much less executing on my advice, you can never fire me. You feel beholden to me. It's very dangerous. It's very, very dangerous. So what I see sometimes when people come in, I think they're a little tired of the runaround with the large bank or wealth manager. And they come in, they say, I'm ready to invest on my own, use a guide, you're my guide. Invest in yourself, invest for yourself, hourly advice for self-directed investors. Robert, I got it. Here we go. Here's what I have. It's 25 funds, 35 funds, 20 different stocks, 10 different bonds. You look at it and your eyes will water thinking, how? And oh, by the way, no performance advantage at all. More complexity, more fees. Good for them, not for you. Because I will confess, as an advisor, sometimes it's tough. Hey, year after year, you stick with your index fund? I mean, maybe I ultimately think you do need some sort of, it can be valuable to have a check-in for various psychological reasons and to ensure that you're staying on course, but not because you need to rotate in and out of this strategy or that strategy. And then in closing, confusing speculation with investing. Preach, preach, preach. He says the 12,000 companies in my index funds produce cash. They return that cash in the way of dividends and stock buybacks. He then juxtaposes that with gold, crypto, and futures, saying, no, you're just buying high, selling low, or trying to buy low and sell high. You're not farming. It's the old Warren Buffett. Hey, if you've got a farm and it produces so many bushels of corn and it still produces that corn, you shouldn't be that worried about the notional value that you're paid for that farm. Shouldn't worry about it. You should be focused on what Mr. Roth says, dividends and stock buybacks. That's the corn being produced from the field. Don't worry so much. That's speculating. It's gambling. You can get caught in, I bought for X and I want to sell for 2. A little bit of gambling. And you stayed till the end of the show. So you get car knowledge. There's a lot of tariff talk out there. I'm trying to follow as best you can. I might talk more about it next week. I don't want to jump the gun because they haven't been really flushed out yet. I think there's still confusion on what, I just saw Mexico got a provisional for, hey, we're going to not have tariffs on these goods, and maybe you get a month, all that stuff. So who knows? Market's trying to anticipate it. It's tough. That's why I see the market go up and down and up and down. And it's trying its best. But do you want an affordable, reliable, new car and you don't know what to do? Because, let me tell you, buying a new car right now, I do this for some people, and I love doing it. Some folks, we get real in the weeds on their personal finances, and we go so far as to look at their cell phone plan and their insurance, and they want to buy a car, and how should they buy it, and where should they go? My latest deep dive, because we talked dishwashers in the past, and we feel like we handled that issue with excellence. I hate to talk myself up there, but with excellence. We're now going to talk about cars. I've found, what people are really selling for a great price? Sedans. Now, you might say that's not cool, but do you want a $20,000 new sedan? Let me tell you about two cars, the Chevy Malibu and the Nissan Altima, both of which, certainly the Chevy Malibu, this is the last year they're going to make it. So Chevy's decided they don't make money on these cars. I think the Chevy Malibu's made in Wichita, Kansas. Super reliable, about 20 grand, brand new, all the features you can handle. Altima, same deal, probably about 21 grand. Brand new. All the features you can handle. Simple can win in the automobile buying category as well. So we harp on that in investing. Keep it simple. Keep your costs low. Boy, with cars, the same thing can be true. So if you're willing to do it, and I think both look like great cars, and you don't want to spend a fortune on your car, take it from me. Drive a sedan. Be different. If you're an index fund person, you're different already. You already marched to the beat of your own drum. That's good. And what is that beat telling us to do, team? It's telling us to keep our cost low, our investing simple, and our time horizon long, because that's what's going to give us the best shot on our investing journey. Until next week.